Investors Chronicle.
Welcome to the Companies and Markets Show. It's Thursday, the 9th of May, and the Bank of England is maybe, just maybe, opening the door to an interest rate cut as we record. It's finally a reasonable temperature outside as well, and things are hotting up for UK investors too, because we have a number of things we're going to talk about today of particular interest in relation to the UK market. The first being right at the bottom of the cap scale, Filtronic, a company that's been around for a long time but has grabbed attention in the past few weeks courtesy of a tie-up with Elon Musk's SpaceX. Mike Fahy will be on hand to discuss that. Then we're looking at potential winners from interest rate cuts, a topic everyone's thought about plenty of times over the past year or so, but one which, as I say, might now finally be nearing reality. Julian Hofmann is here to give his thoughts later on, as is Alex Newman. Lastly, we're going to talk about Wood Group. Trading update is out today as we record. Yesterday, they reported another bid approach. Mark Robinson and Alex again are going to discuss that a little further later on in the show. Mike, we'll start with you, though, in Filtronic. You have been looking at the company this week, possibly in a bid to take your mind off Manchester United's continuing failings as a football team. But we won't dwell on that latter point. What can we say about the company, this tie-up with SpaceX, as I say? Before we get to that, can we talk about the history of them as a listed company? Because they have been on the market for a long time, which some people may not realise.
Yeah, I won't immediately link the two things you've just talked about by suggesting there's a change at the top of both coming. Yeah, Filtronic's been around since the 70s. It was created by David Rhodes, who was a lecturer at the University of Leeds in electrical engineering, and he took a bunch of his brightest PhD students and they started to manufacture components for radar, originally for the Tornado aircraft, and then that continued to grow, mainly operating in defence for about 20 years until it floated on AIM in the early 90s. It had a bit of a stellar rise on AIM, used the shares to make a bunch of acquisitions, and was really kind of tangentially linked to that dot-com boom era, focusing on telecoms. His equipment was used in a bunch of different things, including mobile phones, cell towers, etc. But then around the time of the dot-com boom was worth about 2 billion-ish market cap, and its revenue peaked a couple of years afterwards at around 400 million. It's even to this day, it's a fraction of that size now, because it kind of hit a rocky patch in between the rollouts of 3G and 4G, which was a period, I was speaking to the chief exec, Richard Gibbs, about this. He said during that time there were quite a lot of storied names in the industry which fell foul of the same thing. Marconi was one, Plessy was another. There was just a great big gap between 3G and 4G, and the company selling that equipment found themselves in a tight spot. Filtronic itself had worldwide operations at the time, things in China, in Australia, etc. But it was obviously carrying a lot of debt and sold a lot of those down. It did well to survive, really. When you look at its results and what it was going through at the time, and the chief exec, Richard Gibbs, says he's only been there for about 4 years, but he says he occasionally comes across a canny fund manager in London who bought at the bottom, and because they used a lot of those asset sales to return cash to shareholders, there was some that made a decent return for it, as long as you weren't one of those that bought at the top of the market when it lost 99% of its value within a 20-month period.
Yeah. As you say, it has trundled on for a while. Its turnover last year, 16 million, so it is very small nowadays. Yeah. Before we get to the SpaceX aspect, what does it do now? Because it's focusing on 4 end markets.
Aerospace and defence is one of those. Defence has really been kind of bedrock. If you look at its its turnover was 16 million last year. It's quite lumpy over the last few years, and I think part of the reason for that is that these orders in aerospace and defence, by nature, are quite lumpy, and it is a supplier to companies like Kinetic and BAE Systems. It produces bits that they use in radar, for ground radar, it does the lot really, ground, air, sea. That is one component of what it does. Another bit of defence, which quite a bit of its work is classified, but it talks about mission critical communications on a battlefield. So and obviously it's in radio frequencies, so you can imagine the type of applications it has there. Space is an area that they only really started to look into a couple of years ago. That's another area. And the other is telecoms equipment. Now, telecoms equipment was its mainstay for a long time, but as Gibbs himself explains, in quite a few areas, it used to make cell towers, for instance. It just became commoditized out of the market. A lot of what was in that was just pretty much metal that once Chinese companies it worked with to provide some parts, worked out what else was in there, started undercutting them on price. And so the bits of telecom that it focuses on now are the bits where he says they still can really have a niche and add value. And some of that is the backhaul links between cell towers that relay signals between telecoms towers, which are miles apart, which, funnily enough, is really what brought them back into space, because the radio frequency signals it was sending horizontally between those towers at different frequencies also seem to work vertically between ground control stations and near-Earth orbit satellites.
Mm. So this deal then is interesting, not just because of the company, as you mentioned, it's had deals with big companies before, BAE and the like, but also because SpaceX has some warrants as part of it, pending delivery of certain things. Can we talk about it in a bit more detail?
Sure. So it came about because Filtronic has I'd worked on some similar pilots before, which never really came to anything. They're called HAPS, which is something, I can't remember, but something to do with pseudo-satellites. So the fact that the likes of Facebook and Google both had projects in this area where they had with Facebook, it was a glider. With Google, it was balloons in the stratosphere, which then relayed signals down that were meant to be used to provide broadband to remote areas. But in both cases, Facebook abandoned theirs first. Some of the engineers that worked on that went to Google. Google couldn't really monetize what it was doing, and it shut its program down. And those engineers then eventually end up at SpaceX, which is where the link came and where they first took a call. And the first call was basically exploratory, asking them if they could possibly produce an amplifier at a certain frequency band that would relay signals up and back to satellites. And from that, they just kind of developed. And the first order was placed last year. Last year's order was about 2.3 million. It was pretty small beer at first, and they couldn't really, at the time, it was anonymous. It was described as a leading near-Earth orbit customer, and SpaceX. There's not too many of those.
Yeah.
No, but from then, the orders have kind of ramped up, and accompanying the announcement of the strategic agreement this year was, I think, the fifth order for about $20 million. So it's become quite sizable given the scale of Filtronic's operations. You know, it's that one order is, as you've said, is equivalent roughly to about last year's revenue.
And the stake as well is dependent on more orders coming through ultimately.
So there are two lots of warrants. One for 5%, equating to about 5% of Filtronic's share capital now, is for about $37 million, about £30 million worth of these amplifiers that Filtronic has been supplying for the last year or so already. And Richard Gibbs reckons that they will probably hit that sometime this year, given the size of the latest orders and the amount that they've already provided. The second lot for another 5% is for a range of similar amplifiers but at different frequencies, which will take a little bit longer to manufacture. So they're looking at maybe 12 to 18 months, although I'm sure Mr. Musk in his inimitable style will be pushing for earlier and earlier delivery.
So what's the potential upside from here? Because the share price did go up 50% in a day, I think it was, in response to this deal. What does the valuation look like now, and what's the potential for further growth?
It's not only 50% in the day, it's threefold over the past year. Market cap now is just above 100 million, which, if you looked at this a year ago, would have pretty much seemed almost impossible. On evaluation terms, I mean, this year, I think the house broker Cavendish has adjusted operating profit rising from 237,000 last year to 3.4 million this year. And again, for that to step up next year to 6.6 million. Obviously, this is all going to depend on future orders from SpaceX, and there's clearly a key customer risk there in SpaceX now becoming quite a dominant part of its revenue. But the relationship seems pretty solid, and also SpaceX doesn't seem to want to tie Filtronic down to exclusive agreements. It's happy if they go off and sell this technology to other people.
Which, they may be on more radars now, no pun intended. The threats to the business, conversely, I suppose also we can talk a bit about the valuation and what's happened there and how that's factored in the forecast. But let's start with the threats. Commoditization, something you mentioned early on, is a risk. There's also, as you alluded to right at the start with the Man United comparison, there's a change of management, which in this case is definitely happening.
Yeah. Well, I think we won't go into whether both cases are definitely happening.
Yeah.
But Richard Gibbs has been there for 4 years or so. I asked him about whether or not he wanted to, why would you not want to see something like this through? But he's 65, and the company has a bunch of things on its slate. Its main operation is in this technology park up in Sedgefield in Durham, and partly because of the amount of new orders that are coming in, they're moving to much bigger premises on the same park. That it takes quite an intensive period, a lot of focus over the next 9 months or so. There are a bunch of other initiatives on the go, and he was saying it really needed a chief executive who had a 5-year runway, and given his age, he decided that wasn't him.
And the other businesses, similar businesses who could eat their lunch in theory, Texas Instruments, the US business, much, much larger, of course.
Yeah, so they specialize in radio frequencies. In the piece, I mentioned that they design filters at very low frequencies. The other equipment they design for very high frequencies. But they are generally quite niche markets, and they build the chipsets for them. The likes of Nokia, because I asked who the biggest competitors are as well, and some of the biggest competitors are the biggest customers, people like Nokia and Ericsson, who build the towers that its equipment are fitting onto. But it tries to keep quite a tight hold over the design of the chipsets that the filters and other amplifiers go into. So it won't really license technology. It wants to manufacture a whole solution. The issue with that is that once those markets, because they are quite niche markets, but once those markets become bigger and bigger, then it does start to attract interest from the likes of a Qualcomm and a Texas Instruments, who can obviously produce at scale, which would then bring prices down.
Well, just to go back to the valuation before we move on, trade up 38 times earnings for this year, but it falls for next year, so quite a bit. So it's really about delivery.
Yeah, indeed. They trade at 38 times this year. That falls to 19 times next year. It pretty much halves. There aren't many forecasts further out than that, but obviously there's a lot to do before you push for forecasts further out anyway. They have to deliver on these orders. They have to deliver on the same equipment at new frequencies. And they've got other work as well for the MOD that is still in the early stage but is developing. So there's it's fine having orders on the book, but turning those into revenue and doing it profitably
is the challenge.
Yeah, indeed.
Of course, as well, we should take those estimates with a pinch of salt, being there from one broker and the house broker. That such is the nature of small caps or micro caps. Yeah. Indeed, the track record over the years isn't promising either, as well. But as you say, there are definitely some positive signs there.
Yeah, and there's it does seem like there's a mutual respect between the engineers there at SpaceX who were very complimentary about Filtronic and its engineers and their ability to ramp up and deliver what they wanted quickly. I think SpaceX is a company that is almost kind of pathological about vertical integration and doing everything in-house because they want things done quickly and cheaply. And the fact that Filtronic have done this and they have signed a strategic agreement is clearly a mark of respect.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to talk about one of our features this week, which is all about mid-caps. The mid-cap segment of the market, like most segments of the market, has had a better time of it in the past few months. Julian, can you set the scene a little bit about your thinking when writing this feature, first of all?
The reason for the feature itself was I started researching how markets reacted to the aftermath of a crisis, which was the starting point for this. And the crisis, obviously, over the last few years, we've had a pandemic, we've had the war in Ukraine ongoing, and there seemed to be a strange effect on smaller cap and mid cap shares than there were on large caps. So the immediate aftermath of this crisis saw large caps return to profitability relatively quickly. There are reasons for this. Obviously, they are larger operations. They've got global income. They're able to offset costs much more easily. The outcome of that is that mid-cap shares are now, for the first time in many years, fundamentally cheaper than large-cap equivalents. And it begs the question, really, whether that will now presage a recovery in that particular part of the market that outstrips the market as a whole. So that was the basic thinking behind the feature. So I started digging into which sectors were most likely to benefit from a shortening interest rate cycle, which doesn't seem to be happening at the moment, but at some point interest rates will come down. And what I came up with was this kind of homegrown in-country industries that seem to benefit most from highly cyclical recoveries, and that was essentially the starting point of the feature.
Yes, as we record, the Bank of England, they've held rates this month as expected by 7 votes to 2, though, rather than 8 to 1. And some of the initial comments do seem to open the door to a cut either in June or August. We are recording before the press conference, so they may try and pour cold water on that later. We'll see. Can we talk a bit, first of all, about the detail of that discount for mid-caps, small caps relative to their history and large caps?
So at the moment, as things stand, the mid-cap sector is valued at about 13.3 times earnings on average, PE of 13.3, and the large caps have overtaken them at about 14, a PE of about 14. And what's unusual about that is that it's a whole standard deviation away from what the norm should be, which is actually should be reversed. Historically, over the last 40 years, really, small cap and mid cap shares have outperformed large cap in terms of valuation, except at times in the aftermath of a crisis. So the last time we saw this kind of inverted price to earnings valuation was back in the mid 70s. So we're going back a long way into market history, and the starting point from that, from an investment point of view, is that the recovery in the aftermath of that flip in valuation has always been far greater for mid cap shares than it is in absolute terms for larger cap shares. It's quite an interesting dynamic, and it seems to be one that only comes around once in a generation, really. I mean, that's what has got a lot of investors interested in the middle part of the market again. And because it's working off a lower base, the absolute return from any kind of recovery is going to be far higher than just sort of sticking with the top 100 shares. So it's quite an interesting time, although it does need more certainty about where interest rates are to be a full analogy with, say, 1976, 1977, where there was a clear point where rates started to come down, and we're not quite at that point yet. I don't think at this point of the cycle, but there's definitely the building blocks in place for quite an interesting market movement.
We saw some of that at the end of last year when markets really, albeit ultimately got ahead of themselves and pricing in a lot of rate cuts, but we saw the sensitivity of the mid and small cap indices to that belief, that thinking as well. So as and when policy does loosen, we might be able to expect more of the same. Another interesting point in the piece you mentioned was also something you don't really think about in relation to what are ultimately higher growth stocks, or should be, which is the dividend payments. The dividend yield on the index is actually quite interesting now.
Yeah, so the yield is actually growing at a faster rate for mid caps than for large caps, and the reason for that is because it has taken longer for companies without this global exposure to recover to levels before the pandemic. And obviously that's reflected in the fact that dividends were held lower for longer if you were in a mid-cap company. But that cycle is reversing now, and the latest forecasts say that dividend growth in mid-cap shares is about 10% for this year, which is, I mean, a pretty decent uplift when you consider the context. And that's really a consequence of the fact that their underlying earnings and revenues are recovering to pre-pandemic levels pretty quickly, and that's related to the fact that because they are based very much in one country, it depends on how the economic background for that country or for the UK. It depends very much on the uplift in the economic background as well as much as anything else, and but that is starting to feed through, and it's starting to feed through in higher dividend yields, or at least higher payouts. The yield is obviously a consequence of the price movement itself, but there is evidence that their dividend growth is now outpacing what you would find in the FTSE 100, which is a very interesting development. We don't usually think of mid-cap shares as income shares, but there is definite signs that their operations are sort of coming back into sync, and
dividend
they're
growth is
generating
what it's all
cash
about, and the yield is a function of the price.
As well as
it is interesting that those two are aligning
aligning
in some ways. The yield of the 250
growth.
index is close to exceeding the FTSE 100 for the first time in a decade, and that growth is there as well, which is a positive. Can we talk a bit about one of the companies you highlight? Because ultimately, however much we, or I in particular, like to prevaricate about, or prognosticate, I should say, about the macro, it is to do with fundamentals, of course, still. And one company you highlight in the piece is Howdens, quite an interesting business. It
is an interesting business. It's if you've ever been to an industrial retail park on the edge of a town, you usually find a Howdens joinery. It's also closely watched by a lot of retail investors. It's a very popular share. What was interesting was that they seem to be looking at a spike in trading volumes after a relatively good quarterly update that they had recently. And I looked at the company as it's a classic bellwether kind of share. How Howdens' performance tends to be how the 250, the FTSE 250, or the other mid cap indices perform as well. And if you see there's this kind of strange disconnect between the share price and the fact that their trading is actually coming into line again. So the share prices had been in decline for some time, and it always seems to lag where the business is going, which is quite a strange state of affairs, really, because usually shares kind of predict what, on the basis of estimates, what might happen. And Howden seems to do the opposite. The share price tends to decline just as the company's fortunes take a turn for the better. So it's a very odd inverted bellwether share. And I chose it really for that reason. And at the moment, it seems to be taking in, benefiting really from the fact that the UK economy, particularly, it seems to be in a mild recovery phase, if not in an outright boom of any sort. But it only really needs, the company only really needs the combination of relatively stable house prices, because people buy kitchens and things like that when they move house, and slightly stable, if not lower, interest rates in order to grow its volumes exponentially. So it's a very geared kind of share, and a very geared company towards economic recovery, and it just makes it interesting from that point of view. It is growing at its fastest rates by certain measures since the 1970s. So it's been around a long time, and it seems to provide investors with an almost inverted buy signal.
Alex, what are your thoughts on the mid-cap part of the market? Any companies in particular you're thinking about, or just that overall macro piece we've been talking about?
I suppose the definition's always important here. So I suppose the confusing thing about the UK market is that about half of the FTSE 100, I suppose, to international investors, or maybe slightly more US-focused investors, probably doesn't quite meet the criteria of large cap, i.e. $10 billion plus. So, but I suppose, just to kind of be schematic, we can sort of look at the FTSE 100 and the FTSE 250 as large cap, mid cap comparators. The one thing I was just looking through Julian's piece and some other commentary on mid caps in the UK. Another thing to bear in mind, particularly maybe when we're looking at dividend yields, is just the surfeit of investment trusts that you have in the FTSE 250. So depending on whether or not you exclude those, I think that can skew it can skew quite meaningfully how you define that sector in terms of its leverage, in terms of its cash returns, in terms of its dividend yield. Because investment trusts tend to be trading at a bit of a discount to NAV, which for dividend-paying trusts inflates their yield somewhat. And I suppose in terms of returns, the FTSE 250 and 100 indices, despite we often talk about how they differ, I suppose the FTSE 100 being a slightly more globally focused, non-sterling earning group of companies, which is kind of less to do with the UK economy than the 250. Despite that, their performance has broadly mirrored one another over sort of 1, 3, and 6 months. I think year to date, the FTSE 100 is up slightly higher than the 250. So that's really interesting, particularly in the context of the ongoing concern that so many people have with UK equities around the consistent, I think we're up to 35 consecutive months of UK equity fund outflows, which is probably more of a concern liquidity-wise for smaller companies, because if there aren't willing buyers out there, then it's going to hit their prices harder. So, yeah, kind of a rambly answer there. I suppose that just to tie it into interest rates, given the negative pressure liquidity-wise on the market, let's see. But I don't think it will naturally follow that just because interest rates start to come down, that mid-caps, just because they have better pricing or they look cheaper, that they're going to re-rate at a sharper rate than the FTSE 100. Despite the domestic orientation of the mid caps, because we've just seen that over the last 3 years, really, that valuation can become quite detached from sort of broader market pricing. So I hope I'm proven wrong, and actually that the mid caps can catch up, because they have had like small caps have had a tricky couple of years.
Indeed, it's a good point as well about the investment trusts and needing to exclude them, which does lower the yield a little bit on FTSE 250, albeit, I believe, looking at some figures I've got here, FTSE 100 ex ITs yield, trailing yield, I think this is 3.8, FTSE 250, 3.6. So it's still relatively close and decent yields there, albeit we are in a world of higher interest rates nowadays. We must remember that as well. The potential for growth, as Julian said, is the important thing there too. We're going to turn to our final segment of the show, though, now. Mark, you've been waiting very patiently to talk about Wood Group, about which there is a fair amount to talk about. Why don't we start with the trading update, first of all, before we get on to the latest bid approach. How did that strike you this morning?
The ongoing saga, which is Wood Group. Now, the main point, or the one that sticks out from this morning's update, was the fact that Wood Group managed to increase the group margin despite an increase in operational work over that period, because conventional wisdom has it in oil services, or more accurately energy services, where the group is concerned. The operational side of the business is usually lower margin, because that just relates to ongoing maintenance work. It's something that rigs and other energy sites can't avoid. And this time around, their project work, which is construction and engineering, that trailed away in terms of revenues, because it could well have been a timing issue there as well, because a number of projects as well came to number of contracts or other came to an end during that period at the same time. By the same token, margins were on the rise there as well, which is interesting. That could simply reflect, I guess, the fact that input costs generally have trailed away compared to the first quarter during 2023. And we should remember, too, that in relation to marginal profitability, it was a fairly indifferent performance last year as well. So this could be something of a recovery, although it could also have something to do with the ongoing restructuring plan, or simplification plan, as they put it, which has been somewhat delayed, but it may well be having the desired effect.
You've clarified what Wood Group does, which is important, because I did my usual thing of going straight in and assuming everyone knew. It is a oil services group in the middle of this turnaround. Let's talk about the approach, because last year, Apollo, and at the end of 2022, the private equity group, approached them with a few bids. We've now had an approach from a Lebanese company, Sidara, which was rejected by Wood Group, and that seems fair enough, given it was below about 15% below Apollo's final bid last year. What's your take on this? It's clearly still in play.
Yes. I mean, it can be, Sidara's bid can be termed as possibly opportunistic as well. However, it was about 25% up on the 200-day moving average, but that's just a reflection of how Wood Group's share price has been performing over that period. It's been in downtrend actually before the pandemic too, and a lot of the problems stem back to its acquisition of Amek Foster Wheeler, which I think was back in 2017. So yeah, this is an opportunistic bid. It might be just they're trying the waters at the moment, and who's to say that another suitor might come in prospect as well. But my general feeling is that it's a prospective bid, and whether anyone else comes is your best guess and mine, really.
They've had interest from an activist as well. I say interest, fairly unwelcome, but we'll get to that in a moment. What about the turnaround plan, though? Because it has struggled with this big deal and with the debt load and lumpy contracts. And what it's been trying to do as part of this simplification plan is generate cash flow, ultimately, in a more reliable way, and generate positive free cash flow. There was some disappointment last month at the full year figures when it said that was now going to be 2025 rather than 24, mainly because of the cost of the simplification program, effectively pushing out some of that revenue, some of that cash rather. There was, it's another case of jam tomorrow, I think people were feeling at that stage. But how do we see this going? There have been signs of progress in recent years. What's your sense of how things are turning around?
Yeah, I don't think we should be necessarily too surprised that time frame has been pushed back a little bit as well, because it is hard to get a handle on your working capital when changes are afoot within the business itself. And I think they're looking at, once this is over and done with, they're looking at annualised savings. I think it's either 50 or 60 million pounds, which is not insignificant given the size of the company itself. I guess, as you say, the market was disappointed when that's been pushed back through to 2025. But I was looking at the consensus projections for free cash flow, and they do go up dramatically from the end of this year. It's not that it's going to be a 10% increase. It's something in the range of about 60 to 70%, which is highly significant. Now, we're hoping that they just reiterated that point today, and we're hoping that there aren't any nasty shocks along the way there. But based on what we know, it appears to be bearing fruit at this stage as well. But part of that process too, which is something that you alluded to earlier on, is the very nature of the contracts. Because in the past they've struggled with large segmental contract work, whereas they're looking to streamline that whole process, and that gives you far more clarity in terms of revenue projections too. Whether they'll be able to source these type of contracts in the current environment is difficult to say, but there was some good news in terms of operational work that was coming through this time around. Total, I think, was one of the new contracts that was added through the period, and Equinor as well. We should mention that apart from their oil and gas work, they did diversify over the last few years too, taking on more in terms of renewables. And I think their consultancy work rather has picked up too. So there are signs that the program itself is working, but with the caveat is that the group unfortunately has disappointed investors more than once in the past. So we wait on developments.
Well, they've got a new CFO now. Last month, he arrived, Arvind Balan. And when thinking about cash flow, I suppose the optimist would say he arrived from the civil aerospace division of Rolls-Royce. And Rolls-Royce clearly is a company where that huge uptick in cash flow that people have been waiting for a long time finally did come through the other year. I don't think it was all down to Mr. Balan, but there might be some interesting parallels for the optimists. And I was listening to the earnings call this morning, just the quarterly update, and he was really talking about, as you would do, but nonetheless talking about how his plan is to shift the entire business, or certainly the 200 senior people in the business, to focus on cash, to focus on not just on profit and loss, but that cash coming through the business, to have a sense of where it is. I think he said we're trying to be much more week-on-week focused rather than just focusing on the half-year mark, things like that. So trying to remove that lumpiness, trying to get a better sense of, receivables versus payables, things like that. So clearly he has a big plan there to do that. We'll see whether he is successful. Alex, what are your thoughts on Wood Group at the moment?
Well, I think it goes to show, so this is a company that, if we can focus on the negative, because, it has been a pretty negative story, I think, generally over the last few years, with the caveat that obviously there is some value being sniffed out, by these two bidders over the last year. Acquirers are going to look at, the enterprise value to cash profits and the fact that they record revenues of about $6 billion a year, and think, okay, this is a very undervalued company. But it really, as you alluded to, has really struggled to push profits, so either at the gross or operating level through to the net profit level. And obviously, cash management has been an issue, and there's always really an issue with large oilfield services companies, because they have so many, they've got such high working capital needs, and it's it's a very tricky balancing act. But it does appear, both from the analyst community and from what management have been saying, that things are slowly turning. I think it's a harder situation to turn around than Sparta's probably overly simplistic suggestions imply. That doesn't mean it's not a potential buy and that there isn't a turnaround story here. But I think the idea that
this is Sparta, the activist.
Yes, so you should say,
yeah.
the activist that's kind of been agitating for them to either list in the US or to just agree to the next bidder who comes along. I think that's pretty simplistic reading of this, and they've labelled this as a company, just to return to our previous item, that suffers from the UK mid-cap curse. And we can certainly say there's little UK-centric about Wood that should mean its business is tied to the UK economy. But I mean, you do also need to show that you are profitable to win investor favour. So I think there's sort of three things going on. There's a turnaround story here, but we need to kind of see the working, and at the same time, it's clearly, they're clearly valuable assets for a long-term minded investor to think about. So it's probably not the interest is not going to go away. It seems, have to be at a much higher level than the offers currently on the table.
I just think they're going to have trouble as well securing the type of contracts that they need. Perhaps part of the reason why they're looking for smaller, more nimble contracts and their more regular cash flows is because of the nature of the industry at the moment. I read something from Wood Mackenzie that was saying that overall expenditure is going to be about $22 billion in the current calendar year. That compares to $27 billion in the immediate preceding year, and we're still well off the pre-pandemic rate as well. This is a partial reflection, certainly, of financing difficulties with the industry as well, and the fact that a lot of companies now are looking at project procurement in line with ESG mandates, and this has affected the risk appetite within the industry itself. And one last point as well with Amec Foster Wheeler, I think that actually the purchase price there was double the current market capitalisation, which gives you some idea of the problems that they've faced since then.
It's been a long road, indeed. I think with the project work you referred to, Wood does put some store in its consultancy business and the sustainable consultancy business, which is trying to advise people on what to do in relation to ESG mandates and the energy transition and things like that. So you'd hope they'd get something out of that, albeit it's still a small part of their business for now.
Yeah, they couldn't be accused of not, trying to determine the direction that the wind was blowing. I mean, because they have increased that renewable part of the business, and you say consultancy work isn't nearly as capital intensive as other parts of the business, which is and it's a significant portion of overall revenues at the moment. And in fact, in terms of profitability, that was the biggest kicker in the update today in terms of sort of cash profit growth.
Yeah, I say small. You're right. It's not as small as the word implies. It's not a majority of the business, but it is growing quickly. It's not subscale. Anyway, there's a lot going on with Wood, and we will keep our eyes on the company as ever. But unfortunately, we have run out of time today. Thank you, everyone. Thank you to Mike, to Julian, to Alex, to Mark, and to our producer, Vic Thornton. We will see you next time on another Companies and Markets show.